Alright guys, so in this video we're going to be discussing what are some of the tax considerations that you have to give attention to if you're going to leave your country and move to another country. My name's Aaron, I'm from offshore in Asia. We help people move, invest and do business out in Asia predominantly. So if you're looking to move out to Asia and you want to be careful not to run into any big tax trouble along the way, we can help you to work through your specific situation and make sure that you have no surprises and you can get out here, live a good life and not pay too much tax while you're at it. So the first point I'll discuss here is, are you going to trigger tax residency in your new country? So if you're moving to Thailand or Malaysia or the Philippines, wherever it may be, is this country that you're moving to, are they going to regard you as a tax resident and therefore are they going to want to tax you? Now every country has its own rules around residency. For example, if you're moving to Thailand, you can trigger tax residency by being in the country for more than 180 days in a tax year. Malaysia is very similar, they have a 182-day rule, but it's not always so cut and dry. There are other things that come into your personal residency. These can be things like where your family is, where your financial ties are, where is your life set up, where is your habitual abode, where is the place where you go back to after you finish your traveling. So just because you think you may or may not be a tax resident, it might not always be the case, so you just want to tread a little bit carefully here. The other part to tax residency is your corporate residence. So this will only affect people who are running businesses, but if you're running a business, then you've got to determine where is your business going to be regarded as a resident. That will usually default to the place that you have incorporated that business, the country that it was registered. But if you're operating that business out of another country, that country may regard that corporate as a resident of that other country and want to tax you as well. So you've got to be a little bit careful there. When it comes to corporate residency, tax authorities will often look at a thing called central management and control. So without getting too technical, this usually boils down to where is the company operated from, where are the decisions made, where are the meetings, the board meetings, the annual meetings being held. Basically, where is the company controlled from? The tax authorities will often look at a thing called permanent establishment as well. So where are you set up? Where are your operations being carried out from? It can get very confusing. It's not always cut and dry. There can be a lot of grey in making a determination towards your corporate and also your personal tax residency. So it is something you have to give a bit of attention to. It is very important because especially if you are making, well, the more money you make, the more tax you're paying, the more is at stake. So you want to make sure that you're not being taxed twice for one. And then if you are being taxed twice, if two countries regard you as a resident, then is there a double taxation agreement in place to avoid double taxation? Often it is a lot easier to trigger residency in a new country than it is to become a non-resident of your old country, and that's where you can run into problems with two countries wanting to tax you. So even though you may have departed your old country, you're not even living there anymore, there is a chance that they can still regard you as a tax resident and continue taxing you as a tax resident. Sometimes that will work out in your favor. Maybe you want to stay a tax resident. Other times you may not want to be a resident. You may want to cut your ties and move your assets elsewhere, move your assets and your business to a more favorable tax jurisdiction. Whatever you want to do there, you just have to make sure you plan accordingly and put the right steps in place. Residency is a big part of this, but then after that, once you do determine where are you going to be a resident, will you still be a resident of your home country? If you have a business, where is your company going to be regarded as a tax resident? Once you determine all these things and you've checked with the lawyers and the accountants, everyone has signed off and everyone is happy, then it's time to start planning your financial affairs around your new tax residency status. For example, is there an exit tax in your old country? If you hold capital assets, it might be property, it might be shares in your home country, and you leave that country, is there going to be some kind of exit tax, like an exiting capital gains tax? You're leaving the country, so they want to tax you up until that point where you leave the country. That can be determined as a capital gains tax event. Sometimes there are deferrals in place where you can put off that tax to the point of sale of the asset down the road. That might work for you. Maybe you just want to pay your money and get out. And of course, once you know where you are going to be a tax resident, what are the tax rules in that new country of your tax residence? For example, do they tax foreign sourced income in that country? Do they have a capital gains tax? What is the tax on property if you're going to go into landlording? Every country has different rules. There are some quite favorable tax jurisdictions in Asia that we like to work with. So there usually are some options there that we can work with depending on where you're living, where your business is based, where your investments are based, and so forth. For example, you may be a tax resident of Thailand, a non-resident in Australia. You might have a share portfolio in Australia that is paying tax at the non-resident rates. And yeah, that might work for you. It might keep things simple, but it is certainly not optimized either. An option that might be better for you is to move your investments to a place like Singapore that has a 17% corporate tax rate. It doesn't tax dividends and it doesn't tax capital gains. Now, if you're interested in learning more about setting up a brokerage account in Singapore to capitalize on their favorable tax regime, head over to our website, offshoreinasia.com. You can go to book a call there, you can send us an email, and we can help you to set these things up if that's something you are interested in. You may want to look at investing in the country that you're living in now. Is that something you're comfortable with? Do you think it is a place that is worth putting capital into? If you are an Australian, you may be happy to pay a higher rate of tax in Australia as a non-resident, knowing that you have your money in a market that you are familiar with. These are all things you have to weigh up. Just because somewhere has a low tax rate doesn't mean it's the best fit for you. You have to be able to sleep well at night as well. That's probably the most important thing. And then if you do go non-resident status in your home country, you've moved elsewhere, you've moved abroad, does that have any implications for you down the track? Were you hoping to be eligible and apply for the old age pension in your home country when you get to a certain age? Now, if you've become a non-resident in that country, in your home country, does that affect your chances of getting the pension? Because sometimes it can. So there are many things you have to think through here. It's not something that should be done without proper consideration. So if you are looking at making a move overseas, I would suggest put some thorough planning into it around what your residency status is, what visa you're on can affect your tax status as well. Not so much around your tax residency, but more so that some visas may have a specific taxation carve out in it. That means you are going to be taxed a certain way. You may be taxed differently to regular residents of that particular country. So have a good look at the fine detail on that as well. As I've covered here, there are many things that you have to give proper consideration to. It's not something that should be done on a whim. Now, if you want to speak to someone about working through your taxation, your residency, placing your investments in tax favorable jurisdictions, someone to help you put all these things in place and get to a point where you can move over and start a new life in a country with peace of mind. We can help you to work through all of this stuff. We have partners, lawyers, and accountants all around Asia. I'm an accountant in Australia myself. So if you are looking for help with that, head over to our website, offshoreinasia.com. You can go there, you can book a call. There's a link, a button in the top right of the screen. We can have a chat and help you to put some plans in place to make sure you don't get a nasty surprise down the track. Thanks a lot for watching. We'll catch you later.